What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered.
What's up, everybody? Welcome back to the CPA Zone. This is the podcast where we turn complicated tax and accounting stuff into something you can actually understand and maybe even enjoy. I'm your host, Ryan Pulis. Today we're going to talk about the Whiteco Factors and cost seg studies. So Whiteco refers to a tax court case from the 70s. So if you're a real estate investor, understanding these factors can help you better understand and interpret your cost seg reports. So we're going to look at what the Whiteco case was all about, what the 6 Whiteco factors are, how they influence cost seg studies today, and how you can use them to your advantage. So a bit of a refresher. So what's a cost segregation study? Before we get into the court case, let's just quickly recap that. So in simple terms, a cost segregation study is a way of breaking down the costs of a building into different categories so you can depreciate the parts of the building faster. Instead of lumping your whole building into 39-year depreciation for commercial real estate or 27 and a half years for residential, you identify parts of the property, carpet, lighting, landscaping, that can be depreciated over 5, 7, or 15 years rather than the longer 39 or 27 and a half years. So why does that matter? It's because faster depreciation means a bigger deduction sooner. That means more cash in your pocket now instead of years from now. And you can use that to reinvest in more properties. So here's the catch. So the IRS doesn't just let you kind of wave your hand and say, here's a 5-year asset. I want to deduct that one now. You have to have a legitimate basis for your classification. So that's where this Whiteco court case comes in. So Whiteco Industries was the company. This was a court case from the 70s. Whiteco Industries, they're a company in the outdoor advertising business. So think like billboards, the big giant signs you see along the highways. Whiteco owned a lot of them. And like any good taxpayer, they wanted to depreciate those billboards faster. The IRS came in and said, wait, those billboards are part of the real estate, permanent structures. You have to depreciate them over the same schedule as a building. And Whiteco pushed back and said, no, these aren't permanent. We can move them. They're not attached in the same way a building is. And in fact, we do move them fairly frequently. So they went to tax court and the question became, are these billboards real property? So that's the slower depreciation, 39 or 27 and a half years. Or are they personal property, which opens up the doors for faster depreciation? The court realized they needed some type of framework for making this decision. And out of that came the 6 factors that we now call the Whiteco factors. So here's basically what happened. The court essentially said, we're going to ask 6 questions. The answers help us decide whether something's personal property or a permanent improvement to the land. So let's just go through each one. I'll try to translate into plain English as we go. So the first factor is the property capable of being moved? So if something's bolted down with concrete or steel beams, it's going to be really difficult to move. But if you can pick it up and move it, even if that requires something like a forklift to move it, then that tends to lean towards personal property rather than real estate. So in Whiteco, the billboards could be dismantled and moved. So that's a point in their favor. The next question is it designed to be moved? So something might technically be movable, but is it intended to be moved? So, the partitions for cubicles inside of an office building clearly meant to be movable. However, a brick fireplace in your house, not so much. That's going to point more towards real estate versus personal property. So these billboards were designed so the sign faces and structures could be relocated to new sites. So this also helped Whiteco's case. The next question, number 3, was it in fact moved? So if you say something's movable, have you ever actually moved it? That's going to play a factor. So Whiteco did, and they had proof. They relocated several billboards over the years. So that's another point in their favor. And then we have factor 4, how substantial of a job is removal of the property and how time consuming is that? Like, is it readily movable? So with Whiteco, the signs were able to be moved, and they were moved. So another point in their favor. And we come to factor 5, which is, does moving it cause damage? Is it going to be damaged by moving it? So can it be moved or taken down without wrecking it? If so, that leans towards personal property. The court found Whiteco's billboards could be dismantled without destroying them. And then finally, factor 6 is, how long has it remained in place? And if it's been sitting in the same spot for 30 years, it's going to look more permanent. But if it's moved every few years based on need, that suggests it's not a fixed item, that it is more personal property. So some of Whiteco's billboards had been moved around to follow traffic patterns and advertising demands. So a bit of a point in their favor here as well. So how did it turn out? As you could probably guess, Whiteco had a lot of factors in their favor. So the court sided with Whiteco, said the billboards were personal property, making them eligible for faster depreciation. And ever since, tax professionals and cost segregation specialists have used these 6 questions to figure out whether certain building components should be depreciated as personal property rather than real estate. So you fast forward to today, when a cost seg study is done on a building, the engineer's not just looking at blueprints and invoices. They're also applying a level of judgment, and the Whiteco factors are part of that judgment. So for example, carpet, clearly movable, designed to be replaced, frequently is replaced. That passes the Whiteco test as being personal property. Decorative lighting fixtures, often movable and replaced, not part of the structural lighting system. Those are also going to tend to lean towards personal property. Things like built-in cabinets. Here it depends. Are they custom built into the walls and never moved? Or are they modular and designed to be relocated? So that's where these Whiteco factors will help when analyzing something like this. So it's all about substance over form. Just because something's attached to a building doesn't automatically make it part of the building for tax purposes. So you have to use your judgment here and apply these factors. So some takeaways here: if you own or are buying a property, make sure you explore a cost segregation study, especially if you have a property of significant value and you can utilize those losses. Like for example, you're a real estate professional or using the short-term rental loophole. So the Whiteco factors, they really give you this legal foundation for classifying certain assets as personal property. And as always, documentation matters. So if you ever move something, keep a record. If you can show the IRS you've actually relocated assets, that's very powerful, points in your favor. And make sure you're working with professionals. And a cost seg study should be done by someone who understands these factors, an engineering type firm that is going to be able to stand up and support you in an audit if it ever comes to that. So Whiteco case might be 40 plus years old, but it's still relevant today. It really plays a big role in these cost seg studies, which are key to a lot of tax planning for real estate investors. And just remember, the faster you can depreciate qualifying assets, the faster you can free up your cash flow for your next deal. So that about does it for today's episode. If you found this helpful, please share it with a friend and another investor or business owner. And if you've got questions about cost seg studies, send them my way. Maybe we'll do a listener Q&A episode. But until next time, have a great day. Are you interested in becoming a client? Click the discovery meeting link in the show notes to schedule a free call to discuss our services. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.